If I had to look at this market right now from scratch, knowing what I know about how rallies behave after a hard shock, how traders get sucked in at the highs, and how easy it is to mistake strength for a free lunch, I would not be trying to call some heroic top here. I'd do everything differently. Most people think the hard part is guessing whether the market is bullish or bearish. That's not really the hard part anymore. The hard part is knowing when not to touch the thing, even when it looks like it wants to go straight up forever. Today is Thursday, April 16th in New York, and comment the day and date you're watching from. And if you value what I do here, support the channel by subscribing and drop John A.G. Best in the comments so I know you're here with me. Because here's the deal, the broad market just pushed into fresh record territory again, and that matters. It tells you money is still willing to pay up. It tells you the tape still has lift. It tells you the path of least resistance has been higher. But right where people get the most excited, right where headlines start sounding the cleanest, that's also where little warning signs tend to creep in. Not disaster signs, not end-of-the-world signs. Just those little hairline cracks that say, hey, don't be careless up here. So this is not some crash sermon. This is not me pounding the table for a market collapse. And it's definitely not me telling you to go stand in front of an uptrend just because you're bored. The move that trapped people out, squeezed people out, and left late bears staring at the screen in disbelief, that part has largely done its job. The easy short wasn't here. The easy short got left behind. Now the smarter game is something else entirely. Now it's about patience. Now it's about whether this market can pull back without actually breaking itself. Now it's about whether buyers can show up at better spots instead of forcing entries right at the ceiling. And that is a very different conversation from, should I short the top? Because when the S&P and the tech-heavy side of the market are pressing records, you don't need to overcomplicate the first question. The first question is trend. And trend, at least on the surface, is up. Fresh highs are fresh highs. You can argue about internals, you can argue about breadth, you can argue about participation. We're going to do all of that. But price itself has already told you the dominant push has been upward. So if you're fighting that blindly, you're not being brave. You're probably just being stubborn. That said, I also don't want to pretend every fresh high deserves to be chased like it's a door that's about to slam shut. That's where people get punished. They see green, they feel urgency, they convince themselves they need in right now, and then the market finally gives them the pullback it should have given them 2 or 3 sessions earlier. Same bullish trend, very different entry. Same market, very different emotion, and that's the whole point of this update. I'm not looking for a dramatic reversal first. I'm looking for a respectable higher low. Maybe the market just keeps floating and barely gives anybody a chance. That can happen. Strong tapes do that. They grind, they frustrate, they make disciplined people feel late, and then they keep drifting higher anyway. If that's the path, fine. We respect it. But if we do get a pause, and I think at some point we probably should, I want the pause to look constructive. I want it to look like digestion, not damage. That means I'm watching for shallow consolidations above recent breakout zones. I'm watching for gap fill areas that get tested and then defended. I'm watching for the kind of pullback that feels annoying, not fatal, because annoying pullbacks inside an uptrend are usually the ones that set up the next leg. And I want to push back on one thing right here. A lot of people hear bearish divergence and immediately jump to, therefore short it. No, absolutely not. Divergence is not a command. It's a caution sign. It says momentum underneath the hood may not be as clean as the headline index print. It says your reward for chasing up here may not be that great. It does not automatically say the whole market is about to fall out of bed. That distinction matters. On the big index side, the broad tape looks like a confirmed uptrend that still has room to stay healthy even if it backs off. The tech side also looks strong, even though it feels a little less complete in its breakout than the broad market. Small caps are the odd one out. They haven't really matched the clean record-breaking behavior. They've spent more time chopping and less time leading. I'm not ready to call that a deal breaker, but I'm not going to ignore it either. In healthy rallies, leadership can start narrow and broaden later. But if broadening never comes, eventually that becomes a conversation. So no, I'm not panicking over small caps lagging. But I'm also not giving them a free pass forever. Same thing with low volume. Everybody loves to scream about light volume when markets melt upward after a scare. And sometimes that concern is valid. Sometimes low-volume rallies are just air pockets waiting to get smacked. But after a violent downside shock and a fast recovery, lighter participation is not some alien event. It happens. People get cautious, they wait for confirmation, they don't trust the bounce, then price keeps rising without them, and eventually some of that sideline money has to make a decision. That's why I'm not automatically bearish on light volume here. If bigger sellers were truly convinced this was the place to unload size, you'd expect more obvious damage. You'd expect uglier reactions into strength. You'd expect heavier selling pressure, not just a lot of nervous commentary online. The absence of heavy distribution doesn't prove the market is invincible, but it does make me less interested in fantasy crash calls. Still, under the surface, some stuff has cooled off. Participation has not looked as explosive as price. Breadth has not looked as enthusiastic as price. The junk bond side has not confirmed as cleanly as price. Bitcoin has not exactly been screaming, "Risk is back, baby," the way some people would want. And equal weight action hasn't really stolen the show either. That combination matters because it tells me this market is rising. But not all parts of it are rising with equal conviction. A lot of the heavy lifting still appears to be happening in the larger names, the obvious names, the names people hide in when they want upside without too much imagination. That can continue for longer than people think. But it also means the better play is probably not to buy the highest print of the strongest chart after everybody already noticed it. It's to let the market come in a bit and show you whether buyers still care. Now, once you move through sectors, the picture is still mostly constructive. Big tech still looks like the engine room. Consumer growth names have improved. Semiconductors, despite all the drama and all the hand-wringing, still look like they want to stay important. Financials have also helped a lot, and that matters more than people admit. When banks are putting up sturdy numbers and trading desks are feasting on volatility, that gives the tape another leg to stand on. Recent results from major banks were strong enough to reinforce that risk appetite hasn't gone missing. And on the chip side, this is where fresh context matters. One major chip equipment giant just raised its outlook again, and one of the biggest contract chip manufacturers in the world did the same, talking about stronger artificial intelligence demand and pushing spending plans toward the high end. That doesn't guarantee every semiconductor name goes straight up from here. It does tell you the larger industry backdrop still has fuel. Now, here's where I'll add the counterpoint. Just because those giants are upbeat does not mean every stock tied to that theme deserves blind faith. In fact, late and strong themes, the easiest mistake is assuming a good industry backdrop protects every chart. It doesn't. Some names are extended, some are priced for perfection, some have already had their move. So even in a bullish group, selectivity matters more up here than it did lower. That's why I'm still thinking the same way across a lot of individual names, not what can I chase, but where can I find a cleaner reset? If a market is healthy, it should be able to pull back, breathe, shake people out a little bit, and still leave enough structure behind for a continuation pattern. That's the setup I trust. The setup where price cools off, the volatility reaction stays contained, and the next push higher comes from a better base. Those are the moves that tend to feel almost too boring before they go. And speaking of volatility, this is one place where I still lean constructive. During earnings season, you can have an elevated volatility backdrop and still have a bullish market. That's normal. Event risk is event risk. But the key is whether volatility acts like it's preparing for a storm or just respecting the fact that gaps can happen. Right now, the bigger message still looks more orderly than panicked, and that matters if we do get a dip. Because if the market pulls back and volatility stays relatively restrained, that's the kind of environment where higher lows can actually hold. If the market pulls back and fear suddenly explodes way faster than price damage would justify, then okay, something may be off. That's the fork in the road I care about. Not the first red candle, not a scary tweet, not some dramatic thumbnail. That. Macro is also part of this story, whether people like it or not. Producer prices this week came in hot on the headline line, even if some of the underlying details were calmer. And the latest beige book said growth was still expanding, but with more unevenness across districts. So this is not some perfect Goldilocks backdrop. It's a market balancing softer panic over energy with still real inflation and still real policy uncertainty. At the same time, the market has clearly been relieved by easing war fears versus the worst-case scenarios traders were pricing not long ago. Stocks hit fresh highs, oil came off the panic peak, and the dollar tried to stabilize after a nasty slide. That combination is supportive for risk in the near term, but it is not the same thing as permanent safety. If peace optimism wobbles, or if oil decides it wants another tantrum, or if the dollar and yields pop together, then yes, this market could absolutely need a reset. From recent market updates, futures traders still aren't pricing some huge surprise at the next policy meeting, and that matters because it keeps the near-term liquidity story from turning into a full-blown headwind overnight. But again, I don't want to oversell that. Markets can stay calm right up until they don't. That's why I care less about what everybody says the Fed might do, and more about how stocks react when the dollar firms, when yields bounce, and when a hot name finally slips for a day or two. Are you buying strength up here, or are you waiting for the reset? Let me know in the comments, because that answer usually tells me more about the market than the headline does for me now. So what do I actually want to do with all of that? Simple. I want to respect the uptrend without marrying the highs. I want to stop pretending every caution flag is a sell signal. I want to stop pretending every new high is a buy signal. I want to stay in the middle of those two mistakes. On the broad market, I'd rather buy a decent pullback than force a fresh breakout. On the tech side, same idea. On small caps, I want proof that a dip can hold and that participation can broaden. On individual leaders, I want higher lows, inside days, bull flags, gap-fill defenses, and the kind of price behavior that says institutions are still willing to support the move after the excitement fades. And yes, there are a few names where tactical shorts can make sense. That can happen in any market. A stock can run into a moving average stack or a prior supply zone or a look above and fail setup, and maybe that gives you a fast downside trade. Fine. But I would treat that as tactical, not philosophical, right or right out. No speeches, no ego. Because the bigger tape still doesn't look like something I want to lean against aggressively. It looks like something I want to let come to me. That's the difference. And one more thing. If you're successful, share your success story in the comments so others can stay motivated. Because most people lose not because they picked the wrong narrative. They lose because they forced the wrong location. They buy after the obvious move. They short after the obvious drop. They confuse emotion with timing. And then they blame the market when really the market just punished impatience. So heading into the next stretch, I'm watching earnings, I'm watching the dollar, I'm watching rates, I'm watching whether credit continues to behave, and I'm watching whether this rally can finally broaden out a little more beneath the surface. Credit spreads have actually narrowed recently, which is one reason I'm not treating this as some hidden disaster tape. But if that starts reversing while breadth stays lazy, I'll care. I'm also watching the big leadership complex very closely, because if the strongest names can digest without cracking, that keeps the bullish script alive. If they start failing one by one while the indexes barely hang on, then the market becomes much trickier than the headline would suggest. So no, I'm not shorting some imaginary cliff. No, I'm not chasing the ceiling either. I'm waiting for the market to show me a better handshake. And if it gives me that handshake, I still think continuation is the cleaner base case than collapse. Not because markets go up in straight lines, not because there are no warning signs, but because most of the evidence still says we're dealing with an uptrend that needs management, not a mess that needs a panic button. That's how I see it. Use this to think, not to copy. This is educational, it's my read on the tape, and it's definitely not personal financial advice.